Welcome back to Investing Talk Podcast.
Today, we're looking at Nebius Group. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Okay, Nebius Group, ticker NBIS. Look, the sources we've seen are pretty clear on this.
Yeah. What's the main takeaway?
It's really positioned as a core AI infrastructure play. It's all about the huge expanding need for specialized compute power. That's the driver.
Right. The hardware and software needed to actually run these big AI models.
Exactly. And, the consensus among the sources is if you want that structural exposure to the whole AI megatrend, Nebius sits right at that critical point.
The nexus, yeah. Hardware and software deployment.
And the performance they've shown. Well, that just raises the stakes. Can they keep it up? That's what we need to figure out.
And the thinking is the next 6 months really hinge on, what, 3 things?
Yeah, basically. Earnings momentum. Gotta keep delivering. Then, how fast AI really gets into the mainstream enterprise space.
Okay.
And finally, how institutional investors react to all that, their activity.
Well, looking back, the demand signal isn't subtle, is it? It's more like a huge flashing light.
Yeah, or a cannon blast, like you said. I mean, the numbers are just staggering.
Shares up 549.6% year over year. Let that sink in. 550%.
It's wild, especially when you compare it. U.S. software sector, up about 28.6%.
Okay.
Broader U.S. market, maybe 20.1% in the same time frame.
So Nebius isn't just beating the average software company. It's lapping the field multiple times over.
By over 500 percentage points, yeah. It's a massive dislocation.
Okay, but that kind of run, it just can't last unless the fundamentals underneath are truly special, right? Something transformative has to be happening.
Exactly. So let's, put the headline number aside for a second and look at the engine. The financials. What are the margins telling us?
Yeah, how healthy is the actual operation?
Well, the sources describe the financial health as, frankly, robust, especially on efficiency and pricing power.
Okay, give us the numbers.
TTM gross margin that's trailing 12 months is 53.7%, which is, pretty solid for this kind of complex infrastructure provider.
Respectable, yeah. But
here's the kicker. The TTM net profit margin is 76.3%.
Wow, 76% net. That seems incredibly high. What does that actually signal in such a competitive market like cloud?
It signals a few things. Yes, really effective cost management. But more than that, it implies they have significant, durable pricing power.
Meaning customers are willing to pay a premium.
Exactly. They're paying up for Nebius's specialized AI compute because, well, they probably can't get quite the same performance or, crucially, the integration anywhere else.
So it's not just generic cloud service. It's specialized proprietary stuff.
That's the key. Highly specialized infrastructure. And that gives them leverage.
And that efficiency, that pricing power, it flows straight to the bottom line. In other words, backs up the bull case.
Totally. We're looking at $243.5 million in TTM net income. Serious money.
But, okay, the market knows those numbers. That's partly why the stock is up so much. We need to look forward. What about acceleration? Projections?
Right, the forward look. That's where all the excitement is, really. Consensus for Q3 2025 revenue is around $155.7 million.
Okay.
But the really crucial bit, the thing management put out there, is their raised guidance. That's a huge confidence signal.
What are they projecting now?
They're projecting an annualized run rate revenue between $900 million and $1.1 billion.
$1.1 billion. That's a massive jump from current levels. And you can bet Wall Street is laser focused on that high end, the $1.1 billion.
Oh, absolutely. If they even get close to that, let alone hit it, it suddenly makes that 549% gain look, well, maybe not cheap, but justifiable.
Yeah, it validates a big chunk of it retroactively.
And they can only really aim that high because they've kept their finances tidy. Balance sheet discipline.
Which is unusual for high-growth tech sometimes. Usually it means loading up on debt.
Right. But Nebius reports a low debt-to-equity ratio, just 26.1%.
Okay, let's put that in context. For a company growing this fast, in a capital-hungry sector like AI infrastructure, keeping DE below 30% is actually quite impressive.
It really is. It means they have, financial flexibility, lots of dry powder, as they say. They're not beholden to high interest rates for their expansion plans. Gives them agility.
Which leads us straight to the competitive advantage, the moat. That growth, those margins, they don't happen by accident. It has to be the tech.
Correct. The sources hammer this point home. A durable moat built on vertically integrated hardware and software. optimized cloud platforms.
Okay, but lots of companies claim proprietary tech.
Huh.
What makes Nebius's moat stand out against, say, the giant hyperscalers?
It seems to be the PITE integration. Their systems are apparently designed from the ground up, specifically for things like training and running large language models efficiently.
And the proof is in the pudding, so to speak.
Well, the biggest validation, arguably, was that massive Microsoft partnership, $17.4 billion.
Yeah, that's not pocket change. That's a huge commitment.
It's structural. It says a tech giant like Microsoft needs Nebius to help meet its own AI ambitions. That partnership alone changes the long-term risk calculation for Nebius significantly.
And they're not sitting still internally either. Sources mentioned a new product launch, Nebius AI Cloud 3.0, Aether.
Yes, Aether, codename Aether. And analysts cited in the sources are calling it a potential, quote, game changer.
Is it just a software update or more fundamental?
It sounds like more. Aether is the software layer that really harnesses their specific hardware. It gives enterprise clients tools to deploy specialized AI models faster, more reliably than maybe you could on standard cloud setups.
Okay, so it locks customers in, higher switching costs.
So that seems to be the idea. Lock in those high-margin enterprise and government contracts. Create a sticky, recurring revenue stream that's hard for competitors to just copy quickly.
So it really is that vertical integration story again. The software maximizing the custom hardware. That seems to be the core takeaway.
I think so. And importantly, this integration apparently goes beyond just the main cloud business. It extends into their subsidiaries, too.
Ah, right. Sometimes those get overlooked, but can hold a lot of value.
Exactly. They represent potentially significant long-term strategic options.
Okay, let's pivot to recent news then. What operational catalyst have we seen just in the last few months, say August to October 2025, shows they're moving fast?
They really are. So back in August, they announced a global R&D expansion, pouring money back into R&D.
Which is crucial for staying ahead in hardware.
Right.
And handling bigger AI workloads.
Precisely. Then you have Avreed, their autonomous vehicle subsidiary.
Oh yeah, what about them?
They got an autonomous vehicle testing permit in Israel, which is interesting because, well, the mobility sector needs a ton of edge AI compute.
So it tests and validates Nebius's tech in a really demanding real-world setting, high stakes.
Mm-hmm. And then there's the EdTech division, 10. Don't dismiss that one.
What happened there?
Record enrollments in the U.S. back in September. Analysts are saying this isn't just about adding another revenue stream.
No. What's the strategic angle?
Think about it. 10 is basically training a workforce specifically on Nebius's cloud architecture.
Ah, so they're seeding the market with talent that knows their systems, creates future customers or easier adoption for enterprise clients.
Clever.
Yeah, smart ecosystem building.
Right.
And then finally, in October, just recently, Nebius got external recognition for its proprietary AI hardware design.
Okay, that's important for visibility, especially with institutional investors. Tells the market their tech isn't just internal hype, it's genuinely cutting edge.
Right, so the picture you get is a company, really, firing on all cylinders, expanding infra, proving the tech, building the future customer base, all at once.
Okay, that covers recent achievements. Now let's talk about what's coming up soon, specific dates. If someone's thinking about a trade or an investment now, what are the key dates between, say, November 2025 and January 2026? The things that could really move the needle. Right, the hard catalysts. The big one, the anchor event, is November 11th, 2025. That's Q3 earnings release and the conference call.
This is the moment of truth for that huge guidance they gave.
Absolutely critical. They must show strong evidence of that enterprise AI adoption picking up steam. That's what justifies the current valuation. If they miss, well, the pullback could be sharp.
Okay, November 11th, what else?
Just a week later, November 18th, you have the major ETF quarterly rebalancing.
How does that impact Nebius?
Given its massive run-up, it's very likely Nebius will see its weighting increased in key tech or AI ETFs, maybe even added to new ones.
Which forces those ETFs to buy shares.
Exactly. Could mean significant buying pressure, changes in share float, liquidity, a technical tailwind, potentially.
Got it. And looking into the new year.
January 9, 2026. That's when the institutional investor buy window often opens, a period when the big, long-term smart money might establish or add to positions.
So watching for signals of serious long-term conviction from major funds.
And keep an eye out for January 30, 2026. That's when they're expected to give their Q4 guidance preview. That's our first glimpse into their expectations for 2026. crucial in this fast-moving AI space.
Wow. Okay, so it's a really tacked calendar. Lots of known events driving potential short-term moves.
Definitely confirms that the tactical trade is very much alive here, driven by these measurable catalysts.
All right, let's switch gears slightly to the technicals. The chart. Fundamentals sound great, but price action matters. What does the chart say?
Well, the sources point to a very clear, almost textbook pattern of higher highs and higher lows. That confirms the uptrend is structurally pretty sound.
And the range is just massive, right?
It really is. As of early November 2025, it's trading between, say, $126.30 and $132.15. But compare that to the 52-week lowdown at $17.39 and the high up near 141 cents.
That 549% return is right there on the chart, and it's still kind of consolidating near the highs.
Now, the sources note volatility is still high. Average weekly move is about 17.3%. That sounds scary, but
Analysts are interpreting it differently.
yeah, they're seeing it as stable volatility within that uptrend, which they interpret as active accumulation.
Why is that distinction important? Stable high vol versus panic vol.
Because when pros see high vol but the stock keeps making higher lows, it suggests big players are using any dips to buy more shares. It signals conviction, not nervousness.
Okay, makes sense.
Plus, technically, it's holding firmly above both its 50-day and 200-day moving averages. Classic confirmation of a strong secular uptrend.
And the human element, analyst ratings.
Pretty bullish. 4 to 5 covering analysts rate it a strong buy. So high conviction on the institutional side seems to be there.
Okay, strong fundamentals, strong technicals, strong sentiment. But now let's get into the more speculative stuff, the rumors. Because these could unlock value way beyond the current consensus, right?
Exactly. This is where you move from the knowns to the high-stakes what-ifs. If even one or two of these rumors pan out, the upside could be massive, and it's likely not fully priced in yet.
Okay, let's hear them. What's the biggest one swirling around the core cloud business?
Strategic partnership talks. The word is Nebius is in late-stage talks, possibly with a specific, though unnamed, Fortune 500 cloud customer for a really big multi-year deployment.
And if that customer is, say, a major bank or a defense contractor?
It would be huge validation. It positions Nebius almost as critical infrastructure. Game-changer potential there.
Okay, what else? Financial engineering. Spin-offs.
That's another hot topic. Speculation about spinning off their in-house AI hardware division.
Why would they do that?
To unlock its standalone value. We've seen this playbook in semiconductors, right? The idea is the hardware unit, currently sort of bundled within the overall Nebius valuation, might get a much higher multiple from the market on its own, especially after that external design recognition.
So the sum of the parts becomes greater than the current whole.
That's the theory. Instant value unlock.
And you mentioned Triple 10 earlier, the EdTech arm. What's the rumor there?
That Triple 10 is prepping for its own separate IPO.
Capitalize on the EdTech buzz and separate a different business model.
Exactly. High growth, lower capex service business spun off from the capital-intensive core infrastructure provides non-dilutive cash back to Nebius too. Smart move if they can pull it off.
And lastly, Avreed again, the autonomous vehicle unit.
Yeah, unconfirmed reports, but they suggest that Avreed might be launching autonomous delivery pilots, specifically in key European cities.
That's a big step up from just testing permits.
Yeah.
Operating in complex European cities.
Would dramatically boost Avreed's perceived value. Again, unlocking that hidden non-core asset potential within Nebius.
Okay, so it's clear these aren't just side projects.
Yeah.
They're potential upside multipliers that help justify maybe some of that high valuation.
They certainly contribute to the bull narrative, but, we have to keep our feet on the ground. High growth always comes with high risks.
Right. Let's talk about the potential downsides. It's not a guaranteed win. What are the main risks?
The biggest one, flagged by management itself apparently, is execution and capex risk. Scaling this kind of proprietary infrastructure globally is incredibly expensive.
Specialized chips, data centers, dealing with regulations everywhere.
All of it. That massive capital expenditure could start to pressure margins, maybe squeeze that amazing 76% net margin we talked about if costs rise too fast.
Even with their pricing power.
It's a risk. Depends on how fast costs rise versus how much they can charge. And then there's just plain old macro risk.
Meaning the stock's high valuation makes it vulnerable.
Yes, it's trading at a premium if the whole market corrects or if there's even a temporary slowdown in AI or cloud spending. A stock like Nebius, with its high beta and huge run-up, could fall further and faster than the market. Amplified drawdown risk.
But the sources mention some resilience.
They did. Apparently, Nebius has shown some resilience during past tech downturns, suggests maybe its core customers see its services as essential, not something they cut first.
Okay, so let's try to wrap this all up. We've got strong fundamentals, aggressive guidance, proven expansion, a packed catalyst calendar, and these potentially huge speculative upsides, balanced against execution and valuation risks. What's the final take from the sources?
Based on everything, the structural AI tailwinds, that proprietary moat, the near-term catalysts, the overall rating coming from the analysis is clearly bullish, like a 9 out of 10 conviction level.
And it seems attractive to different types of investors.
Yeah, that's interesting. It's one of those stocks that seems to appeal to both. You've got your short-term, tactical traders looking to play the Q3 earnings or the Aether launch news around November.
Quick potential gains there.
Right. And then you have the long-term investors, people looking for that core secular exposure to the whole AI megatrend over years. They're likely looking at the moat, the Microsoft deal, and the potential for those subsidiaries like a Free Day or the hardware spinoff to really unlock value down the road, maybe in 2026.
So ultimately, Nebius Group's fate in the near term seems to hinge less on the high-flying rumors of a spinoff and more on whether that November 11th earnings report confirms the sheer scale of enterprise adoption promised by their raised guidance.
That feels right. If they deliver on converting that $1.1 billion run rate projection into reality, then the momentum we're seeing now, well, it might just be the beginning heading into 2026.